This is going to tell the company if they have any liquidity problems. And the second one is gross working capital, which is the measure of the capacity of a company to continue with the regular activities in a short term. And we're going to see these two factors a little bit more detail in the next slides. And why is important working capital? Well, because the higher the working capital is, the greater the current assets. This means that this is going to help the company to lower the risk of not being able to pay debts or at least reduce them. And the elements of the working capital, which are assets and current liabilities, are going to tell the company the amount that it should have in order to maintain the balance between risk and profitability.
Hi, my name is Alejandro Muños. I'm going to talk about net working capital, which isn't too long. The criteria according to Gitman 1986, in referring to the net working capital, it is the difference between current assets and the current liabilities of a company. It also says or stipulates that it is part of the current assets of the company are funded on long-term funds. Okay, the net working capital should be viewed from two perspectives or two ways. The first one is the static one, that is the difference between the capital employed or set by the company, or it is funded by the company, and the investment in fixed assets. Also, there is the dynamic view. The financial needs occur in the company variations in activity levels. This data and information is governed by the difference between the investment and the short-term liabilities, which is the financing or the funds.
Hi, my name is Guadalupe Morales. I'm going to talk about gross working capital, that is liquid funds available to a business and any assets that are anticipated and will be exchanged for cash within a 1-year period. Also, it's an assessment of the level of gross working capital for a business that can be used to estimate it and is anticipated annual cash flow that will be able for use. Also, the measure and does not take into account current liabilities. Next, please. Gross working capital refers to the total value of current assets and is equal to gross working capital, that is the total amount and available for financing of the current assets. Gross working capital is equal to the total current assets. Next, please. And this is a graphic that talks about the gross margin return on working capital. It's divided into two. The first one is gross margin and the second one is working capital. The first one have the expenses and the sales, and the second one is the inventory, payable, and receivables.
Hi, my name is Cepeda. I'm going to talk about possibly and negative working capital. So the first one is positive working capital. When current asset exceeds current liabilities, it faces a positive working capital. This means that a company has more liquid assets and is making in a negative time. So the next one is negative working capital. Is working to calculate an asset in dollars, which is not necessary. The company is sold or has suspended payment. The negative working capital implies a need to increase current asset. This can be done through the sale or part of fixing asset or non-current assets. Other possibilities are to increase capital where a current